In the alternate version of exercise 8-16, Diaz Company owns a milling machine that originally cost the company $126,300, and at this point they've recorded accumulated depreciation of $94,200. We're asked to prepare the journal entry for the disposal on January 3rd under several different independent situations. So the first situation is there's a lot of repairs that need to be done to this equipment, and it's just not really cost benefit, not worth repairing it. So Diaz is going to go ahead and dispose of the machine, receiving nothing in return. Again, too extensive cost to repair it. So to start to look at this journal entry, we need to think about what do we have recorded on the books currently in regards to this piece of equipment. We look at our T account for the asset account milling machine. We currently have a debit balance that agrees with the cost of $126,300. We would need to remove that in order to show the disposal. Also, accumulated depreciation, being a contra asset account, is going to have a credit balance of $94,200. So right now the book value on our books currently that we would see on our balance sheet would be $126,300 in costs minus $94,200 in accumulated depreciation is $32,100. That's the net amount that would show on our books currently for this asset. So let's start to think about how we build this journal entry, and I'm going to do it a step at a time. Let's first remove the milling machine cost from the asset balance. This is an asset, it's got a debit balance, so we would credit milling machine to remove it because we no longer have this asset. So credit milling machine for $126,300. We also need to remove the related accumulated depreciation. Currently has a credit balance, so we're going to remove it by debiting accumulated depreciation for $94,200. Well, this is great. We remove the cost, we remove the accumulated depreciation because we no longer have the piece of equipment, but we have an unbalanced entry. What we need to think about is compare what we receive, which we receive nothing, is what they indicated, so we receive zero. Compare that to what we're giving up. And what I mean by that is what's the book value of the asset currently on the books? Receiving zero, subtract from that the book value of $32,100 that we're giving up. That would give us a negative number of $32,100. That means we have a loss on disposal. A loss fits in the general category of an expense overall. So we would debit the expense account called loss on disposal milling machine. We would debit it for the difference between the disposal, what we're getting, zero, minus what we're giving up, the book value of $32,100. So we debit it for $32,100, what happens to also be the net book value, because we're receiving nothing, we're just disposing of it, which just happens to be the net book value. I will also note that loss on disposal, I mentioned in general it's an expense. Where it would show up on our income statement would not be operating expenses because it's not a normal day-to-day thing. It would appear as part of the other expenses and losses, so towards the bottom of our income statement, because disposing of our long-term assets like this isn't considered a normal day-to-day thing that we record on the business. Number 2, Diaz sold the machine for $16,200 in cash. So again, start to build our entry, and a lot of it's going to be the same, that we're going to credit the milling machine for $126,300, debit accumulated depreciation for $94,200. So that part of the entry hasn't changed. But in this situation, we're receiving cash, so we're going to debit cash for $16,200, and also our comparison of what we get compared to what we give up is going to be different. We received $16,200. From that, we'll subtract what we gave up, or the $32,100 book value. $16,200 minus $32,100 would create a negative $15,900. So we received less than we gave up. So that also is going to be a debit to loss on disposal, but this time the difference is going to be $15,900. Again, these are independent scenarios. So let's move forward to scenario 3, where Diaz is going to sell the machine for $32,100 in cash, which coincidentally exactly agrees to our book value. So a lot of the entry stays the same. Credit milling machine for $126,300. Debit accumulated depreciation for $94,200. Debit cash, this time though, for $32,100. Let's again do the comparison between what we received, $32,100 in cash, minus what we're giving up, $32,100 in book value, means there is no gain or loss. And if we looked at this and added our total debits of $32,100, $94,200, that exactly equals our credit to the milling machine for $126,300. That means we have a balance entry. What about our next one? We're going to sell, in this situation, the machine for $40,200 in cash. Again, credit milling machine for $126,300. Debit accumulated depreciation for $94,200. Debit cash, but this time for $40,200. Let's do a comparison again. $40,200 received in cash minus the book value of $32,100. This time, the amount we received is greater than the amount we gave up, so that's a benefit to us. In particular, it's considered a gain on the sale, and it's going to be a difference of $8,100. In general, a gain falls within the broad category of our revenue. In particular, the account that we're going to use is a credit. Since it falls under the broad category of our revenue, revenues are increased with a credit. So we'll credit the account gain on sale milling machine for a total of $8,100. And if we wanted to venture into where this appears on our financial statements, it appears on our income statement. In particular, it's going to appear in the other revenues and gains section. So again, not in the general revenues as part of net sales, because it's not a typical thing. It's going to be an unusual thing. So it'll appear in the other revenues and gains section of our income statement.